Great, great.
All right, Stu, take it over.
Okay, taking over. All right. Hi, guys. Welcome to our first SMAS speaker event of the fall season. It's my pleasure to introduce you to our guest speaker, Jim Campbell. Jim's new book, Madoff Talks, uncovering the untold story behind the most notorious Ponzi scheme in history, was published in the spring. So we are very happy to have Jim here to talk about this today. In Madoff Talks, Bernie Madoff goes on excuse me, on the record to explain why and how he orchestrated the biggest Ponzi scheme. Jim also spoke extensively with Ruth and Andrew Madoff to find out what they knew. The results of a fascinating look, almost a decade in the making, into the biggest financial crime in history, a crime that destroyed many lives. I actually know people who were hit by this thing. In addition to adding author to his resume, Jim is a host of the nationally syndicated radio show Business Talks with Jim Campbell and his crime show Forensic Talks with Jim Campbell. He is known for his hard-hitting interviews of leading figures with in the world of business, politics, and sports. Jim's extensive corporate consulting and entrepreneurial business background comes from his years working at Fortune 500 companies. He is the founder, president at JC Ventures Incorporated, a management consulting business. Before I turn over the talk to Jim, I wanted to share something that struck me. Our SMAS logo is a ship's wheel, as you all know, meant to steer us on a course of activities, programs, and events throughout the year. I could not ask for a more apt speaker nor conversation today. Jim's knowledge and understanding of Bernie Madoff's crimes and the subsequent reforms Jim recommends will steer us on a better course. Please welcome Jim as he talks about his new book, Madoff Talks. Jim, go ahead.
Thank you very much, Stu. Thanks for being invited. I'm particularly honored because I got to speak this summer before the Retired Men's Association of Greenwich in what was their first meeting back in person since COVID. And I hope after the Delta variant and everything goes away that you guys are able to get back. But it was great to be honored to be invited by the Stanford equivalent. And I think Carol Shapiro reached out to me first, and then Stu was, of course, organized it. And I think that you'll be stunned by how little is known about the Bernie Madoff scandal. This assumption that there's one man behind a curtain on the 17th floor of the Lipstick Building, which is that distinctive oval-shaped building in Midtown Manhattan, that he ran this thing totally by himself. And actually, he could not have gotten it done without both the system enabling it through failure and some what I call co-conspirators. But let me tell you the story first off, because if you want to launch a book, it was, let's just say, sort of lucky that the evil protagonist happened to pass away right before the book came out. We had nothing to do with his demise, I can assure you. And but I was leaving the Greenwich Radio WGCH studio after doing the morning news center, and I was on the Post Road in Old Greenwich, a couple hundred yards from a mini, a Shell station that I kind of stop at after the radio, which is intense to have a break, look at the papers, and at the stoplight, it comes across my screen that Bernie Madoff passed away, and this is just 2 weeks before the book is out. And from that moment on, and the book isn't even out, so no one's heard of it, my phone exploded, basically, and I started getting calls to do interviews, etc. The Bloomberg had already put me on their website that I was going to be on their radio in 10 minutes from when I was told to do it. So it went from there. Right after, at the same time, I was not having time to check my emails, but CBS Sunday Morning was reaching out desperately, because when they get you on, you have to agree to do no other television prior to their interview airing. So they wanted to get to me first. Now, meanwhile, no one was asking me for TV interviews in those first few minutes, but once they got through, I said to her, I said, well, I haven't done the TV yet. Channel 12 here locally wants to come to my house, and they're just the local and Long Island. Could I do that to give me good practice? And she said no. So my first TV interview was in front of 6 million people on the CBS Sunday Morning. They came to our house that Wednesday, spent 2 hours taping, very nice people, and got it down to a 5-minute segment, which, by the way, the book was coming out 2 days later. And from the minute CBS went off the air, you could track incredible volume on Amazon, pre-orders. And Amazon then proceeded to run out of books 2 days into the launch, which hurt us. The New York Post called me and asked me to write 2,000-word article or whatever length I wanted for the next day, and which I said, that's ridiculous. And so the guy says, the editor says, well, I will tease it on the front page of the paper if you'll do it. And so I did. I got it out in the afternoon between interviews. I got up in the morning, went to their website on my phone to see if the story actually made it, and it was the #1 trending story at the New York Post. I'm going to show you some slides in a bit about how this thing happened, and you'll get a chance to see that. Now, the first question I've always asked is, how the heck did you get access to Bernie Madoff and his family? And I kind of ask myself that question still to this day. But what happened was I was doing an interview with a woman, Lori Sandell, who'd written a book that the family had cooperated with to extent, and I mean Andy Madoff, really. And she said, would you like to talk to Andrew Madoff off the record as part of the prep for your interview? And I said, wow, yeah, I could. He couldn't speak publicly or on the record, obviously, but we kind of hit it off. And it came out in the conversation that, first off, he was going to listen to the show then, which was live, to hear if I said the same kind of things he was hearing from me then. And then secondly, that his mother happened to be moving from Florida, Ruth Madoff, to Old Greenwich, where I live. And I said, well, why don't I just take her out to lunch, because she's not going to know anybody, nor are there a lot of people that are going to want to have lunch with her at that time particularly. And he set it up. So the next day he said that he watched the show, and I met Ruth on a cold December morning at the beach house in Old Greenwich for lunch. She came in. We were the only one in the restaurant there. She had sunglasses on, which she did not take off for a bit, because obviously she was worried about being recognized. She proceeds to eat a chef's salad like she hadn't had a meal in a month. Very open, answered all my questions. As we were walking out, then I said, well, can I get a picture with us? And she stops and she says, you're wired, aren't you? She thought I'd set her up. And when she saw that I didn't, she hooked me up with Bernie. And Bernie said, based on the recommendations of Ruth and Andrew, I'm going to trust that you're going to help set the record straight, and I'm going to cooperate with you. And, I told him I was going to vet every single thing he said for truth, and I was not writing any kind of a book that was going to apologize. That wouldn't help him anyway. And he said he accepted those terms. So I set out to see if I could figure out Bernie's mind, get his side of the story, which of course is unbelievably fascinating how his mind operates, as you'll hear. Secondly, I wanted to be the first media source to determine if the family knew. And the FBI, who I talked to, the Department of Justice in the Southern District of New York, all believed that they had to know. And finally, that no one had told the story of how the regulators really failed putting them all together. And that is probably the single most stunning part of the book, is that untold story. And I'll say in that access to the Madoff family, they didn't know me from Adam. And Bernie obviously had an agenda of trying to fix his legacy. Ruth and Andrew obviously had an agenda to try to preserve their names within the family. Andrew's fiance Catherine Hooper, after Andrew passed away in 2014, cooperated extensively with the book. And again, she didn't know me. She said, even after we finished our interviews and I asked her for a lot of advice on questions that I had, she said that if you find Andy knew, and I believe to the depth of my soul, Andrew did not know about this, but if you find he did know, I will accept it, which still gives me chills that, that she would even think like that. After the book came out, by the way, she watched the CBS Sunday morning news show. She sent me a note saying how much she'd appreciated that I'd gone after the truth and that she hoped I sold 65 billion books. And if you know that number, it's a symbolic number for the Ponzi scheme size. Bernie wasn't acting alone in a sense. He was enabled by several components. Number one is he had what I call 4 co-conspirators. And these were big original investors who bailed Bernie out periodically when he needed it. And in return, they came to have the power to extort big returns out of Bernie. And the biggest of whom was a guy named Jeffrey Pickauer, who made, get this, $7 billion out of this Ponzi scheme. Basically an unheard of guy. Madoff himself stole 800 million to prop up his legitimate firm, and that's 9 times less than Pickauer got. And normally the Ponzi guy steals all the money. The feeder funds, these are hedge funds that fed all these funds into Bernie. He passed on his fees, which no hedge fund manager does, that have essentially the power of a bribe, if you will, and they were willfully avoiding asking him questions. He didn't allow that, which was their job, basically. So I call that willful blindness on that piece. The third piece is what I call the unwitting conspirators, which is the SEC primarily, but the other regulators. You don't get away with something if the regulators have looked at you for 40 years and missed it. And finally, what I call the witless conspirators, which is he had a small group on the 17th floor of the Lipstick Building behind lock and key that ran this for him. They were totally ignorant and unsophisticated of Wall Street when he hired them, and somehow managed to do all these things that they knew weren't kosher, but never figured out it was a Ponzi scheme. There were several ways, and this will surprise you over 40 years too, that this crime could have been solved in 5 minutes, if you will. The first, the whistleblowers, and the book starts off with this. The whistleblowers, in speaking with a hedge fund guy with the magnificent aristocratic name of René Magnon de la Thierry de la Magnon, who had kings and queens and people like that, whose money he managed, told one of the whistleblowers about this secret manager he had who was not allowed to reveal his name. And in describing his results, all was positive, and it was a stock market strategy. The whistleblower knew in 5 minutes that there's no way that could have been true. And that sort of set them off. They didn't know who the guy was, except that Renee got taken away to a phone call, and he overturned a statement on the desk that it had Bernard L. Madoff investment securities. Another way, and this is also pretty amazing, the SEC investigated Bernie 5 times and never found it, but they had a chance, and Bernie described this to me. The Depository Trust Company, the DTC, clears and settles trades. So trades are traced through there. So Bernie told the SEC on a Friday evening that his DTC account number was 646, which was his business account number there. And they could go there and they could trace all the trades through his investment advisory, which was the Ponzi scheme. And it would have taken a phone call. Bernie told me he expected to be arrested over the weekend. The SEC never made the phone call. And then finally, JP Morgan was his bank. Everything funneled into the 703 account. You'll see what that is in a bit. And they had the only view into Bernie's money. And over that whole period of time, they never put together that the most Bernie told me he ever had in there was $6 billion. And obviously wouldn't support a $60 billion scheme. but also that very simply, there have to be payments to counterparties if you're doing trading. There have to be dividends deposited if you own all these stocks. And in all these years, there was never $1 payment to a counterparty, nor $1 of dividends. There should have been $4.4 billion of dividends alone. A Ponzi scheme is designed basically so that it can't last for a long time because of the fact that more money has to keep coming in. You keep having to find more people, and it's easy to detect. Where's the money? Where's the trading going on? Is there independent custodians holding the stock? Who's doing your financial accounting? And by definition, therefore, they can't last. So Bernie's somehow managed to last 40 years. The 17th floor designed all kinds of fake reports, including fake reports of fake reports to fool the SEC, double levels, to the extent that sometimes if the SEC was investigating and they were printing out fake reports on the spot, they would be worried that they'd be hot off the printer. So they put them in the freezer for a bit. So they looked like they'd been around for a while. The SEC did 5 investigations and never uncovered that it was a Ponzi scheme. Why? Bernie never bothered to register as an investment advisor ever. So they came in looking only at the broker-dealer business and kept the rumors were that he was front running, meaning he was jumping ahead of his clients. Bernie ran a market-making firm, which means he was doing trades in behalf of mainly discount brokers, so that Schwab would call in with an order. He would go out to the various exchanges and market makers and get it done for them. And then Schwab got the customer his stock right away. That business was 100% legitimate, had one of the highest ethics levels on Wall Street, and was worth $3 billion separate from the Ponzi scheme. So put this in your head. Bernie was running at the same time on the 19th floor, one of the most ethical, successful businesses. It came from zero to breaking the monopoly of the New York Stock Exchange in market share volume to 10%, third largest. At the same time, on the 19th floor, he's building the biggest Ponzi scheme in the history of mankind. One mind doing both of those things, and he had the exact people he needed on each level, completely honest up here, and down below, people that would do whatever he wanted. His 2 sons ran the upstairs business and the trading desks there, and were not allowed nor had key card access to the 17th floor. So that's the SEC. They kept investigating the same thing they'd already cleared him on 0 for 5 at investigations. SIPC is the Securities Investor Protection Corp. They are the equivalent of the FDIC for banks. The FDIC was created in the New Deal, and ever since that time frame has never not paid $1 of claim for a bank failure, nor has it cost the US government $1 because of the premiums that are set out. Well, the premiums for SIPC at the time that Bernie went down, whether the firm was Goldman Sachs or a one-man broker trading through somebody else, were $150 a year. Needless to say, they did not have a lot of money on board when this thing went down. When a bankruptcy happens, the judges and SIPC appoint a trustee to run it. Somehow, by the time this was done, SIPC had never put a single dollar of its own money towards reimbursing Madoff victims. In fact, they got the money from a group of Madoff victims that had withdrawn more money than they'd put in, and they gave it to Madoff victims who left their money with Madoff. Rather ingenious, while the trustee took $2 billion of fees off of the top of the $14 billion they got back. FINRA is the firm that is the Wall Street oversight firm. They report to the SEC. They do annual examinations, so they were in Bernie's office every year, except that Bernie had been former chairman of the NASDAQ and FINRA had been formed out of NASDAQ. They put basically junior examiners on the cases for Bernie, and they had no power to look at investment advisory business, which of course he ran separate. So they never even looked at. And to make matters almost kind of absurd, Bernie's office was so beautifully looking. He was very obsessive compulsive. The computers were even all of the same alignment. You couldn't leave anything on your desk. It was all beautiful stuff. And he had the good reputation, and he was formerly associated with FINRA. FINRA used to send its orientation class of examiners every year to Bernie's shop to get orientation and look around and meet Bernie. So they were literally in bed with Bernie. After 9/11, FINRA needed temporary office space. They actually housed themselves in Bernie's office space. And we talked about J.P. Morgan, the bank that missed Madoff in 3 different ways, including never really understanding. They thought right up until the end that the account was for the market making business, which was the legitimate business, which had been housed at the Bank of New York for years. Coming out of this, and we'll talk a little bit more in the slides, and when I have about 30 recommendations in the end of the book. And the first one I start with is for individuals to take responsibility for their investments, to understand that the SEC is not a cop up front. They're not going to go in necessarily and find things before they happen. And you can't depend on them, or even SIPC or FINRA, any of these agencies that failed. So if you say, well, the SEC looks at them, they must be all right. No, the first thing to do is what I took from the medical profession, which is a Hippocratic oath, which is do no harm. Understand your investments. Make sure they're transparent. Make sure that the people behind them are reputable, and be conservative. You know, Bernie's returns at the end were around 11% a year that he faked, and those are not excessive returns, right? The market, though, has done 9% a year for 100 years on average. So I say, buy a low-cost index fund that carries the market, take the 9% and sleep at night. And then I have some reforms we'll talk about to make the SEC, to change the culture there, to make them more proactive, and to end the conflict of interest at SIPC and FINRA. What I'd like to do is show you some slides now. If we share the screen, and first off, let me say too that if any folks that offer and decide to buy the book, we thank you very much. McGraw-Hill thanks you, and if you'd like to get it signed, just tell Stu, and I can send a signed book plate. That all you do is stick in the book. Now here's the front page from the New York Post that I told you about, and except that the fact that being called Bernie's prison pen pal didn't exactly make me feel good, and the idiot who came up with that was me. If you look at the story, there's the inside 2,000-word story that was right up in the front. I started off saying I never expected to be his pen pal. I didn't mean to be called by that. I give the Post a lot of credit. He simply could not accept losses, is what they chose to blow up there. And that is exactly right. The market-making business fit Madoff's personality to the T. He was making money on trades, on commissions, whether the market went up or down. He controlled the cost. He was a technology innovator. He helped re-architect, in fact, the whole NASDAQ system by combining everything onto a unified electronic system, And then he goes into this investment advisory business, which he actually ends up having built at the same time, which nobody really understood at the time. And he says, oh my God, I can lose money on trades. He could not stomach losing $1 on trades, so he stopped trading. This is Ruth and I. We had these periodic lunches, and this is outside of the pub in Cascade, and the little pub it's called. And so you can see she's smiling after this lunch as opposed to when she thought I had wired her. And then we did a lot of email and text messaging. And that's how we sort of stayed in touch. After the book contract was signed, and I went to Ruth and I said, and she'd supported the book all along. I said, well, now it's a go and everything. And she said, I don't want to talk anymore. And I respected that. The family told me that maybe her health wasn't 100%, but also they were trying to get compassionate release from Bernie, which failed, but she may not have wanted to get any publicity. I did, after the book came out, Ruth's lawyer reached out to me, and she has been given a book. So she has the book, whether she's read it or not, I don't know. Now, this is Andy Madoff, and that's Catherine Hooper, who was his basically his savior when things went down. You may know Mark, his older brother, committed suicide, and his spouse at the time was trying to separate, and he could not take the whole shame associated with what his father had done, and did not have the resilience. Andrew had Catherine basically behind him totally, and a very tough, resilient guy. He had cancer in 2006. He bounced back from them. Before he died in 2014, he came back again, mantle cell leukemia. He told me that his father killed his brother quickly and was killing him slowly. And here's what the CBS correspondent found the most fascinating. It's on the one side is an example of the letters Bernie wrote me. He wrote me these handwritten long letters and then emails from the prisons, out of the prison system email. And this one was 7 pages, single spaced, beautiful handwriting, both sides, to a guy he did not know, talking all about the crime. On the other side, dear Andy and Catherine, I'm so sorry, Dad. He wasn't even able to say love, Dad. That was his apology to his son. And it's one sentence. All right, let's look at how Madoff faked it. The first thing is, let me just give you the flow. A Ponzi scheme is very simple to understand. No real investment activity is going on, and more money's got to be coming in the front door than it's leaving the back door. That's the only way to keep it going. People's returns, in other words, are coming from other people's money, not from investment transactions. The money came primarily from this big four that I mentioned. Included in there is some old, long-time Madoff investors. The feeder funds, when they took off, the demand was unbelievable. Coming in from Europe, from here, that people could not get enough of Madoff. And the feeder funds funneled a ton of money in. And then there were individual investors who'd gotten in, mainly longer term, older investors, many of whom were not of high net worth, which the perception was that these were all rich folks who lost their money. And that money all goes into the JP Morgan 703 account. It wasn't segregated, but it was essentially a checking account for Bernie. And in that account, then, Bernie was supposedly doing this investment strategy, which was called split strike conversion, which I could never find anybody, either a victim or even the people in his own business upstairs, in the legitimate, who could explain or understand. Even though it was conceptually very simple, it was designed to mirror the stock market and ended up being only 5% correlated to the market, which is why he could say that he never lost any money. And whistleblowers figured that out very quickly. Where did the money go? He always allowed redemptions. Well, a lot of hedge funds, you can't get your money back right away. He always allowed you to get your money whenever it wanted, when you wanted it, up until the end when he was running out. I called it a reverse Robin Hood because basically what he was doing was creating phony returns and giving high returns to the big four type people and lower returns to the moderate net worth people, which means he's basically funneling the money of the moderate net worth people up to the rich people, reverse Robin Hood, if you will. Now, Madoff also, through the back door, laundered $800 million of that customer money out of the 703 account. I'll show you how in a minute, to prop up the market making business when the overall business was having cash flow problems. And then finally, 703 account was used as a piggy bank by the firm. He had a corporate Amex card, and he select employee, 17th floor, charged stuff like tuitions to private schools, their personal vacations, going to liquor stores, all kinds of club memberships, all of which essentially were paid off by the 703 account. This is what an actual fake Madoff statement looked like. Bernard L. Madoff Investment Securities. This woman happens to live in Chappaqua. And as you look at it, it's got all large cap securities, Fidelity Mutual Fund, meticulously laid out. In these envelopes would come in chronological order trade confirmations. It was a rapidly trading strategy. And again, this looks very legitimate, except some things, you know, Bernie didn't cover all of the angles. And his whole big thing was, I'm not a money manager. I'm not taking money management fees. I only make my money on commissions from doing trades. Well, in this particular trade confirm that went to this woman, the yellow box is where the commission charge should be, and it's empty. Now, another ingenious thing he had was, he said that he was linked directly to the DTC. I explained to you what that was before. It's where the securities would be cleared and settled and housed. And he had a screen that he would show people saying, okay, this is exactly the position. This happens to be a US Treasury bill. And the trouble is that it shows for the date, November 30th, 2006. And that's supposed to be a live screenshot, right? Well, the investigators went in and looked at the metadata, which is the underlying data. And the data was actually entered was December 19th, 2006. Here's how he did the money laundering. The money, this example was $4 million. And the money would come out of the 703 account, the JP Morgan, that was his client's money. It would be wired into his personal investment account at Morgan Stanley, which was a 603 account, I think. From there, it's now basically been commingled with his personal funds. But from now, it was then transferred, the $4 million, to the Bank of New York, which was the 621 account. The numbers are the last three digits of the accounts. And then from the Bank of New York account, the $4 million was put into the back door of the firm through trading P&Ls. And as you can see on this one, there's no securities listed, but there's the $4 million profit is at the bottom, okay? That was a fake P&L. Now, here's the issue that also presented. Who ran the trading desks? Mark Madoff and Andrew Madoff. So how the heck could this have been going on without them knowing? And that was the crux of what I had to investigate. You'll see this is from a report by Bruce Dubinsky. He's the brilliant forensic guy that was hired. And he was convinced that the boys had to know. And in fact, he thought the 800 million were covering up $800 million in trading losses, which is why they were in the profit. I never believed that number because it made no sense for a small firm. And I went, and it took almost until I found one of two people in the firm that could give it, that would know what really happened. It's in chapter 8 of the book. It's sort of like a detective story, and it's very interesting, and it presents my opinion on whether the three Ruth, Mark, and Andrew. This is called the infamous Stoop file, which is a Yiddish term for sexual intercourse. It means to push up. This was what Bernie did. You would come in on the opening day of the year, especially as a new client, and he would say, you're going to make 18%. There's your benchmark, and it'd have the benchmark rate of return 18%. It would get down to the end of the year, and he needed to make sure they were going to hit that 18%. And in this case, it had made 10% year to date. So what did he knew he had to make phony trades and gains in the month of December to get that to 18%. And that was done through the Stoop file. Now, the fake investment performance and how easily it sticks out. First off, on the left, that is the actual screenshot of the spreadsheet that Harry Markopoulos, who is the famous whistleblower who blew this thing out, he figured this out, and this is under 2 hours of work that showed that it couldn't, the results, Bernie's results could not be feasible. On the other side, you'll see this chart, and first off, the red line, which represents Madoff's strategy, and by the way, the sterling is from the New York Mets. The sterling equities had 483 accounts, including 16 with the Mets, with Madoff. And this is their returns, but they obviously mirror Bernie's returns. And if you'll notice, they go straight up in a line, and no investment line in the stock market business has ever gone like that. The blue line represents a mutual fund that happened to use the same strategy as Madoff, which is what Madoff should have looked like. And which, since it was a publicly traded mutual fund, was available to see what the split strike conversion strategy looked like in the real world. I said before about the piggy bank. This is a monthly Amex corporate bill that Bernie got, and on it are things like Ruth Madoff charged $57,000 that month. There's a lot of names on there that are family names. There's a lot of names of the 17th floor. There's a lot of money in there. And ironically, it was Bernie's card. He was at zero that month. But this is essentially manifesting what a piggy bank it was. But this was not indicative of whether that meant Ruth knew it was a Ponzi scheme. To her, this was the American Express card that her husband let her use. She did work at the firm for a while, so it's a little bit more legitimate than, say, relatives on there that don't even work for the firm. I took this picture. These are the actual AS400 IBM machines that he ran a $65 billion Ponzi scheme on. When the FBI relinquished control of them, and by the way, they were obsolete since the 1980s, and he ran right up until the end. When the FBI released these, they returned them to Bruce Dubinsky at Duff and Phelps, which was the firm doing the forensics. They were locked in a closet and with other servers and stuff. So I went. He took me in there, and I took those. I took these pictures. This scheme was run off of ancient computers, and there were two conspiracies that the government never even decided to pursue. One of which, in the domestic side, was this was in many ways a huge tax fraud scheme. None of the big four, none of those that were reporting all these fake returns and fake losses to save on taxes were ever nailed for criminal tax fraud, which means they should have been in jail. The other thing that wasn't looked at, which was the international feeder fund flow, contained a ton of dirty money. And I'm talking about Russian mobsters, oligarchs, Colombian drug lords, and that woman on the right ran the biggest one, and Sonia Khan was her name. And the scary thing is she actually looks physically like Bernie as well, as you can see. All right, let me go through the reforms quickly. One is that the SEC is perceived to be cops, but they only actually come in after the mess is made and clean it up. And I have some proposals to try to make them more proactive, one of which is an independent board that would be of Wall Street veterans who are tied into what's going on the street right now and can focus the FBI in areas that are of a bigger systemic impact. The SEC at this time measured itself by how many cases can we get done. So we want easy cases, we want simple cases, and we want them over quickly, which of course Madoff was none of. And secondly, in talking about the failures of SIPC and FINRA, I'd like to see them no longer be self-regulatory organizations, which means the industry oversaw them, and become independent like the FDIC, in the case of SIPC. Also, that on the feeder funds abdicated their responsibility to do due diligence, and that should have been a criminal violation. I think it should be. And if you look at it right now, you can still see things going on and being repeated. If you're following SPACs at all, which is the special purpose acquisition companies, they don't have the requirements of the IPOs, and a lot of under-investigated financials are being in there. Not to mention the financials can be whatever you want to project them to be. So the same problems keep coming up if they don't address them. I think a big problem on Wall Street is what I call institutional conflicts of interest. Robinhood, if you've heard of that, it's an electronic broker right now, is getting a lot of press. It's very popular. They just had an IPO that valued them at $30 billion. They tell you that you're getting free trading. So first off, they're incentivizing you to trade, which is ridiculous and very risky, and eventually will cause you to lose your money. But secondly, how is it free? You know how it's free? They're directing their order flow to exchanges who pay them some money for directing the trades there. It's called payment for order flow. Do you know who invented that? Bernie Madoff. Bernie Madoff never, though, ripped his clients off. He took a small enough piece so that he was able to give them the best price in the market, which is, by the way, a fiduciary requirement. The SEC found Robinhood was taking so much money off the table into their pockets that their customers were paying more in worse prices than if they'd been paying commissions. And so here's a business that is projected itself as a populist, beat up Wall Street. We're going to be helping the common man, trading for them to their own benefit in conflict, and convincing them that excessive trading is a way to get rich, when the way to get rich is slow compounding of putting in money each month into something like an index fund. As I finish up, this tale is in many ways a morality tale. And I put down, my father gave me that moral foundation that Bernie lacked. Bernie grew up, unfortunately, in the shadow of failure. His father had a lot of failed businesses, and I don't think Bernie could stomach failure and, as we said, losses, and he did not have the moral compass. And if you want to take a view of how the floors operated, his assistant on the legitimate business was paid about $125,000 a year. She didn't have an IRA. She was 100% honest. The day after she found out about it, she cooperated with the FBI. The equivalent woman on the 17th floor, who had no high school education, was making $670,000 her final year and had a $58 million phony IRA. And Eleanor, who was the honest administrative system, could never understand who these people she'd worked with, what made them take one path versus the other path. And it makes it a great morality tale. I think there's a lot in the book to help people understand what needs to be reformed, how it should not happen again, but also it's just a great detective story as well. Basically, let me take any questions that you might have now. And trying to get my screen to
Just stop sharing, yeah.
Yeah, I hit the wrong button so it shrunk my, maybe if I can't get your screen full again so that I can, maybe try it this way so that I can stop sharing at the bottom.
Steve, can you stop the sharing?
I can't get to the stop sharing button.
Steve?
I can't.
I'm trying to see. This
Okay.
is not sharing. Do you want to continue?
Can you see me yet?
Yes, we see you, and if you're doing the speaker view, you can see you and the share.
Yeah. Okay. So as long I can see you and hear you, I just don't see your full screen.
Yeah, it was.
Oh, wait a minute. There we go. I got it. It was at the top.
Yeah, when I tried to stop sharing his, it wanted to share mine. So.
Okay.
All right. Now, anybody that wants to ask any questions, I know that they said they want to keep it to an hour or so. So we got 10 minutes or whatever you'd like.
Okay, so Jim, thanks. Terrific talk. Kind of amazing how this whole thing came down. All right, guys, raise your hand to speak. We'll call you as I see you on the screen here. One question per person, and then if you will take your hand down, raise it again if you have a second question. Try to make it questions and not a point of view. And we'll start off with Carl Shapiro.
Hi, Jim. Thanks for the presentation. I enjoyed reading your book. The question I have for you is, when I read your book, one of the things that jumped out was the fact that there seemed to be criticism of the bankruptcy trustees that went after the victims. And you mentioned how they made $2 billion on that. What's your thought? Do you think they spent more time going after the low-end users low-end people that may have had some who were positive winners, but really were were victimized just as much as the net losers, and they could have just maybe cut off their fees, cut off pursuing that and saved on the fees instead of pursuing the low end net?
Yeah, the first thing I don't think it was fair to go after one set of Madoff guys with another. And by the way, this has an inadvertent effect of totally destroying Wall Street credibility, because what is it really saying? That first of all, they didn't recognize your final statement, right? They only recognized your original investment, some of which was 40 years before. So how would you like to open your Maryland statement and find out, well, that final statement is not really your final statement? The second thing was going after some Madoff guys to get other Madoff guys. The third thing is that the trustee represents SIPC. SIPC is supposed to be defending investors. They don't represent the investors. They're trying to save SIPC exposure. Now, I want to be fair to them on what you said. They went after the feeder funds brutally. And so they did do that. They tried to go after the banks, like JP Morgan, and the judge ruled they could not go after banks. So, and they did a tremendous job. If you read their briefs on going after the feeder funds, they capture the corruption completely. But the relentless nature of suing someone who's 75, who didn't know about it, who didn't understand it, and who has to go work at Walmart to make money to survive because they lost all their money, and the trustee is trying to go after their IRA, going after their house. That's just wrong. And a lot of that did go on. I like to give them credit for the quality of their work. I just think they went overboard, and I think SIPC overall needs to be set up so that trustee is doing everything he can to put money in their pocket, not $2 billion in their own coffers. And by the way, that they, like the FDIC, they should have the money to pay that off themselves.
Thank you. Larry Berger.
Yeah, can you hear me?
Yes.
Just like,
Good. I unfortunately was one of the unlucky investors in the Bernie Madoff investment scheme. It was through one of my investment clubs, and I was always amazed that I was getting 15% when he was selling just before the market went down, and I was making a lot of money before the market went up. But it was always in the range of at least 12 to 15% at that time. Fortunately, I've recovered 75 to 80% of my investment. My question is, and I think you sort of touched on it just a moment ago, but how did Irving Picard go about recovering this money to pay back the investors that lost?
okay. First off, that 70% has been gotten back is of the original 14 billion that was invested. Remember, people thought they had 65 billion, but 70% of their original investment has been recovered, at least for the net losers, people that lost more money than they took out. Now, how did he get that? And that's a tremendous job, by the way. Most Ponzi schemes are zero recovered for obvious reasons. The money is not there. Here, there was so much money that was made over so many years. It was there. 10 billion of that 14, right? Now, remember, he's taken 2 billion in fees and expenses. 10 billion of that came from the big four. okay, 7 billion of which came from Jeff Pickhower. Madoff was instrumental in getting the money back from Pickhower. Pickhower had intended to go after only $2.5 billion. He didn't know that this guy had basically $9 billion. And so he got the 7, so 10 of it, he was almost spotted up front, if you will. And then the rest is coming again, remember, not from SIPC, it's coming from somebody who had taken out more money over the years. Now remember, I could have taken out more money that I'd invested, but I may not have that money still, but suddenly I'm liable for it. That 70% is really 22% when you look at what they thought that they had. So again, I give him credit for doing very well in in the Ponzi scheme area, but the numbers are not what they really seem in the end.
Okay, thank you. Joe Bacanello.
Yeah, hi, Jim. A really good presentation. Thank you for.
Thank you.
Yeah, I really enjoyed it. My question, Jim, relates to auditors. As you know, auditors are very inquisitive people. They ask a lot of questions. They have internal control checklists. They go through methodically and they analyze things. And you mentioned a fake P&L, for example. You know, and auditors, they don't randomly just look at a P&L in total. They kind of trace it back to subledgers and that kind of thing. I guess my question is, these auditors, don't you think they kind of dropped the ball on a lot of this? And wasn't Bernie kind of worried about these auditors?
Well, let me tell you, first of all, a big hedge fund, right, should obviously have one of the big 4 accounting firms, right? Somehow
Yes.
Bernie was able to have a one-man accounting firm who was in a strip mall in New City, who was not qualified to do AICPA, the public audits. In fact, it raised questions that JP Morgan at one time asked, somebody should call that number to make sure it's not a car wash. Well, you know what? It ended up being a laundromat because he was money laundering. This CPA had money invested with Bernie, okay, which is also complete conflict. Now let's get to what really happened. The guy wasn't even doing any auditing. You know who was doing the auditing? Bernie had all of his tax stamps and his envelopes and his letters in his office. And his financial staff and this accountant did all the fake taxes. Now what about the hedge funds? Right now, that's a good question, because they did have the big 4, legitimate Price Waterhouse type of firms, and they definitely didn't do their jobs really, as the feeder funds didn't either. And one of the funny things about the feeder funds is they obviously didn't know it was a Ponzi scheme. They wouldn't have left their money there, but they knew it wasn't kosher, because Bernie had every one of them sign off a document saying that they relinquished 100% of investment decision-making to Bernie. The same time, it was represented to the SEC that Bernie had no investment making discretion. He was only doing trades for commissions for these folks. He scripted the answers for Fairfield Greenwich, which was the biggest domestic one based right here in our area. He scripted their lies to the SEC, literally word for word. So those guys should have been in jail, in my belief. The auditing firms should have been held accountable. And the reason Bernie wasn't was he had a one-man guy who he totally co-opted.
You're muted, Stu.
Thank you. Yeah. Thanks, Jim, very much. Any other questions? Well, not seeing any. Jim,
I have a question. Stu, I have a question.
Joe, go ahead.
Yeah, I can't raise a hand, so. Can this happen again? I mean, Enron, Madoff, what have you? Can this happen again?
That's a great question. And by the way, I've sort of looked into that. Harry Markopoulos, who I think you've heard of, but he's the big whistleblower. After this all happened, the SEC did finally meet with him. They would not listen to him before. They didn't understand what he was talking about, and they thought he was a competitor, and they thought he was crazy. But he says that they developed a series of what's called the Madoff tests, and that they're very good now at examining and uncovering a Ponzi scheme. He feels that there's about a 90% chance if you do a Ponzi scheme in the US, you're going to get caught. The only loophole he still sees is offshore. And there you might be able to pull off a Madoff. And Madoff himself told me that the offshore unregulated hedge fund stuff is a lot of bad stuff going on. Now, the second part of your question is, what about other stuff? And there, I don't really see the evidence yet that they've changed their culture so that they can be a cop, so they can get in and get these things before they blow up. The new guy coming in at the SEC has raised a lot of issues about Robinhood. And, but absent anything happening, I can tell you right now, Robinhood will blow up at some point. The Archegos fund that you may have heard of blew up to an $8 billion loss a couple months ago. There's no regulation of family managed hedge funds. And there was no monitoring how much risk borrowed money he had across several firms, right? The SPACs are underregulated, and some of them are starting to blow up, as you've seen, and overall they're down. These things are just sitting out there. I know about them. You guys know about them. And the SEC, in my mind, should be jumping on these things up front. And that's the kind of things that I think the independent review board would be. I mean, if I know about them, imagine guys that are wired right now into Wall Street. Those things I don't think have changed. The Ponzi schemes, I wouldn't recommend trying one unless you want to go to Bermuda or one of these islands that you can do this stuff at.
So the old adage, if it's too good to be true, it's probably not.
Oh, 100% here. That there is just no doubt about it. How Bernie got away with this when it was so obvious that it couldn't do what it said it was doing. You're right. Thank you guys, by the way, great questions, and again, a great audience. You guys are all brilliant retired folks who have years of knowledge base in you, so it's always a lot of fun.
So Jim, thank you very much. I can you do one more question?
Okay.
Ira, did you want to ask a question?
Yes, I did. Thanks for your presentation, James. It was fascinating. I've always been amazed by this event in the financial history of our country. How many times did the SEC actually investigate Bernie Madoff and do nothing about it?
Yep, they did five formal investigations. Ironically, the very first one, they suspected there might be a Ponzi scheme going on. Very first one. But Bernie was able to cover up and get the money to cover it. And he was exonerated. The feeder fund actually was the ones that were told were not behaving well. The other ones all basically looked into front running. They kept thinking the reason he could make these guaranteed returns was, and if I wasn't clear before, remember, he's trading for customers, right? So you have an order for 500 shares of IBM you want to buy. I'm going to execute that for you. But now that I know that you're buying, that's a bullish thing. I'm going to jump right in front of you and buy some IBM shares because you're going to buy right behind me and pay a little bit more, and I'm going to make money off of that. They were convinced that's what he was doing. Okay, so that's a legitimate concern. Now, number one, he was never trading through the market maker, right? So he didn't have that access. Number two, he wasn't even trading to begin with. But the fact is that they couldn't let go of keep looking at it, even though they'd exonerated it. And this is where Madoff was also brilliant by not registering as an investment advisor. The investment advisory examiners from the SEC are a separate team. At that time, they didn't talk to each other. The regions didn't even talk to each other. There were silos all over the place. And so he was never looked at by the people that could have uncovered a Ponzi scheme within minutes. The other thing Bernie did, which was extraordinary, is when examiners would come in, he only let them talk to him. He locked them in a room right near his office, and they only could talk to him and his right-hand man. Nowhere else on Wall Street does the CEO sit down with examiners and not let them talk to anybody else. So he was able to control the narrative, control the lies, send them the fake reports he wanted, and they couldn't talk to anybody else. And that's basically how he got away with it.
It's pretty unbelievable.
Pretty unbelievable.
Okay, Jim, no more. That's it for the questions. Again, really appreciate your spending the time with us. It's a fascinating story. You guys know how to get the book. And any last word, Jim?
I'm very honored to be with you folks. And, I hope you consider getting the book. I think you'll find it a fun read as well. And you guys have great guests, as I saw coming up. So I'm honored to be in that league. Thank you.
Okay, well, you could join us. All right, thank you very much. Joe, I'll pass it back to you.
Thank you, Stu. Jim, thank you so much for a very informative presentation. And
All right. Thank you, everybody, very much.
okay, guys, stay well, stay safe, and we'll see